Well, futures steadying this morning, as we mentioned, after a hotter than expected CPI report sparked a market sell-off Tuesday. But our next guest thinks it might be the time to buy the dip. Max Kettner, HSBC Chief Multi-Asset Strategist, is here to break it down. Max, great to speak with you here on the day. All right, so for all of the people that are going to be all ears to where they should be buying into this dip right now, where are some of the hot spots from your purview?
Yeah, look, good morning, and thanks for having me. I guess, tactically, we're still a bit more cautious, right? So I think there's still a bit more of a basis for some what we call reverse Goldilocks. Not quite the time to buy the dip yet. I think longer term, right, if we're looking sort of 12, 18, 24 months out, certainly we would be still on the more optimistic side for equities in particular. But for the very near term, I think you've simply seen a little bit too much optimism around the whole inflation and disinflation story. A little bit what you guys were just talking about. The market is paying the price right now for a bit of the froth right now. So we're waiting for some of that froth to be taken off and some of those spaces of the market. In particular, I would say when we look at positioning of so-called systematic investors, so those ones that are they're following more mechanical the rules, so something like volatility target-based investors or something like risk parity-based investors, right? People that, or strategies that are really using volatility as an input. And of course, as volatility went down in the last couple of weeks, those kind of strategies have really bought into the market. But now the positioning of those so-called systematic investors is very, very long in equities. So we're really trying to figure out, okay, once they're a bit less long the market, really a little bit less exposed to equities, then it's probably time to buy the dip. Not quite yet, right? Because particularly among those systematic strategies, we're still seeing a little bit too much froth.
So then, you mentioned the term reverse Goldilocks, which some viewers may not be familiar with. What is that, and what are the sort of shocks to the system that a reverse Goldilocks can really play out here?
Yeah, I guess, we can simply call it good news becoming bad news, right? It's a little bit what we've seen yesterday, and it's a little bit also what we've seen in the data in the last couple of weeks, right? Let's see what the retail sales and production numbers bring tomorrow. But obviously, we're now more and more in an environment where hotter than expected activity data actually sends yields up, right? So bonds selling off, and as a reaction for higher yields, that also sends equities and other risk assets down, right? So it's a little bit the opposite, the reverse of what we've seen in November and December, where yields were down, so bonds were gaining, and in conjunction with that, almost everything went up, right? Whether there was bonds gaining, whether there was high yield, whether there was emerging market assets, whether there was equities, it didn't really matter where you were invested, right? As long as you were invested in any sort of asset, everything was swept higher. So reverse Goldilocks for us is then the opposite, right? Then with higher yields, with hotter than expected data, which effectively should be good for equities, right? But with hotter than expected data, that sort of sends yields a bit higher. And with higher yields, that sends a bit of pain across the asset classes. But just to be very clear, that to us is a temporary phenomenon, because at the end of the day, we're only then seeing those temporary sell-offs because things are too strong, not because suddenly we're sort of joining the doomsday camp, right? It's because it's too strong, because activity is actually surprising so strongly to the upside. So that means any kind of really meaningful dip is then to be bought in risk assets.
Max, the IMF World Economic Outlook projects global growth to stay at 3.1% in 2024, rise to 3.2% in 2025. What type of real and meaningful global reacceleration are you anticipating for this year, and how do you price that into your portfolio strategy?
Yeah, look, I guess particularly near term, both earnings expectations and actually GDP growth expectations, particularly for the US, are still very, very low, right? We're just starting now that consensus expectations are again being upgraded as the data sort of trickles in for Q1. So we started Q1 growth expectations and Q2 growth expectations just a couple of weeks ago at 0.4% each, right? Remember, that is annualized. So we're talking about consensus expected at the start of this year 10 basis points of growth, right? So almost close to 0% growth for the US. Clearly, right? Clearly, US growth momentum is much, much hotter. To the point, or to your question, really, We don't need to see growth blowing out to 5% or something, such as it did in the third quarter last year. It is already enough if growth is a little bit better than expected. Because if we have such low growth expectations, right, where it's close to zero growth expectations, it really doesn't need a lot to have a bit of more positive activity surprises. And as long as those kind of low growth expectations, low earnings expectations in the near term, as long as that continues, it's going to be really, really easy for US activity, right, for all the activity data to surprise positively. And that ultimately is good for equities and other risk assets.
I know we'll continue to track that story. Appreciate you taking the time to join us this morning. Max Kettner, HSBC Chief Multi-Asset Strategist. Thanks so much.